investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Affirm. So Affirm reported its results last week, and just going to talk about what its prospects are. Going to talk about its growth rate at all costs. We're going to talk about its valuation of 74 times forward sales, and then we're going to talk about the Amazon deal. So let's just jump right in, right? So as you can see here, they put out their results. So they're expecting to grow next quarter at approximately 62% year over year. So very, very strong, and expected to finish this year at plus 45%. Okay, this doesn't include the Amazon deal, any contribution from there. That they kind of noticed that it's kind of gonna start being recognized as approximately in Q4 of 2022. And doesn't include any revenues from the debit card that they're going to launch. Okay, so for all intents and purposes, it's going to probably grow at 50% year over year. Okay, now the Amazon deal, right? So as others pointed out, the Amazon deal has cost Affirm 22 million shares. Okay, so this is kind of what people have put out, 22 million shares, but these shares are going to be spread out over several years. So the first tranche is going to be between now and 2024, so over the next 3 years. So this is the first 7 million shares, and the remainder 15 million shares are going to be spread out all the way until the end of December 2028. So it's not really that they're going to dilute Affirm by 22 million right now. Okay, so this just to point out that some people came out with all kinds of numbers, and it's just like, okay, slow down. The other thing that I wanted to highlight is that it's really great when you invest alongside management. You know, they have your back, right? So as you can see here, insiders own approximately 6% of the A shares and approximately 40% of the B shares, the voting shares. You also have Lightspeed and Shopify owning some shares there, and it's there's some VC firms as well. So for all intents and purposes, it's not the case that it's just management diluting out shareholders like crazy. This is not what's at play here. You can make a question mark of whether about this valuation as a whole different story, but for all intents and purposes, rest assured the management are very much directly incentivized to see the share price going up and not to dilute themselves too aggressively. Now, the question about Affirm and its profitability, I mean, this is the bear thesis, right? That this company is never going to be meaningfully profitable. And you can see here, adjusted operating margins were negative 17% in this quarter, and they're not expected. So they're going to come up at approximately negative 13% for the whole year. So they're not really seeing meaningful operating leverage on the top end. So, take that as you want, but it's just that it's going to be a long time until this company is going to start making any substantial operating margins here. The other thing that I want to highlight is that actually the percentage of allowance for losses is kind of around, it's still below 7%. So it was up 200 basis points year over year, came up a 6.8 in the quarter just passed, but for all intents and purposes, it's not really that they're very being imprudent with their loans. They've been very, very good with their loans, and it's remained relatively stable at below 7%, the allowance for losses. So that's something that's positive. It shows that their technology works, that their ability to lend credit to people isn't really leading to massive spikes in fraud. So that's good, right? That shows that the business model works. It's good to see that active customers were up 124% year over year. If you get more customers on board, that obviously means it resonates with customers, and if you get consumers, if it resonates with consumers, it's going to resonate with merchants, and if it resonates with merchants, the business model has this kind of two-sided business model where you just adds a lot of liquidity, and that's really the ability to take a small amount of fee away from this liquidity, and it just shows that the overall business model works quite nicely. Now, just wanted to talk about its valuation. Okay, so they've got approximately 300 million. They're going to exit this year with approximately 300 million shares outstanding, and that puts the market cap right now at 45 billion. Okay, so they're guiding this year for their net revenues to be just under 600 million. So that prices the stock at 76 times forward sales. 76 times forward sales is piping hot. I was just kind of thinking as I was writing this, like, what stocks do I know that are priced at this expensive? So obviously Cloudflare is another one that's priced at approximately the same valuation. But I mean, other stocks, I don't really know many stocks that are priced at above 60 times forward sales. I kind of had a look at Asana. Asana was only at 52 times forward sales, only, quote unquote. So I mean, I don't know many stocks, even let's say Snowflake or Airbnb. I mean, I don't know of many stocks out there that are priced this expensively. This is really an outlier. Maybe they can continue growing at a rapid rate, I don't know, but that's what I just wanted to highlight. So there are some positives and some negatives. Obviously, it's still a young company, and they're clearly the market leader here, okay? So they have a lot of opportunity to take market share from incumbents. So there's a lot of opportunity here for them to disrupt fintech. So, you know, do as you will. At 76 times forward sales, it's probably quite expensive, but anyway, we'll see how that goes. If you want to find out what kind of stocks I'm particularly passionate about, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor. You can check out what other people have said in the 5-star reviews. Do your due diligence. And yeah, okay, thanks very much for listening. See you soon. Bye-bye.